Question: in which of the following situations regarding independence would the concept of materiality not apply? Statement 1. Auditing firm owns one share of stock in a publicly traded company under audit. The share is held in a brokerage account. Statement 2. Auditor's spouse owns one share in a mutual fund that owns shares in a client company. The client is a publicly traded company. A. One only. B. Two only. C. Both 1 and 2. D. Neither 1 nor 2. So let me walk through this. I begin with Statement 1. The auditing firm owns a single share in the client. At first you may think, come on, it is just one share, probably worth less than lunch money. But the rule does not care, because this is a direct financial interest, and with direct interests, the size does not matter. Even one share destroys independence. Materiality never even gets a chance to argue its case. And honestly, it feels silly. Imagine having to tell your partner that you compromised independence over a $12 stock. It is the most expensive sandwich you will ever buy. Now moving to Statement 2. Here, the auditor's spouse owns one share in a mutual fund. Inside that mutual fund is a small piece of the client's stock. This is very different because this is an indirect financial interest. Indirect interests bring materiality into the story. If the mutual fund is huge and diversified, your client's stock is a drop in the ocean. Independence is fine. But if that mutual fund is basically a fan club for the client, then you might have trouble. So when I put both statements side by side, the picture is clear. Statement 1 is direct ownership, and materiality does not apply at all. Statement 2 is indirect ownership, and materiality does apply. That means the correct answer is 1 only. And let me give you an example so you remember. Picture yourself auditing Sloth Computers, Inc. You get excited and buy one share directly. Boom, independence gone. Your whole audit is in trouble over something cheaper than a streaming subscription. On the other hand, if your spouse buys a share in a mutual fund and buried inside that fund is a microscopic fraction of Sloth Computers, nobody cares. Unless the fund is basically Sloth Computers Mutual Fund, you are still independent. So the moral is simple. Direct ownership is like dating the client. One tiny move and independence collapses. Indirect ownership through a mutual fund is more like standing in the same grocery line as the client. Unless you are buying the entire store, nobody is worried. Question: in an audit of a non-issuer, if a generally accepted auditing standard is considered an unconditional requirement, which of the following is correct? A. The auditor must comply with the standard in order for the auditor to complete an engagement in accordance with GAS. B. The auditor is generally expected to comply with the standard, but only if the client is being audited for the first time. C. The auditor should comply or must clearly document the reason for departure. D. Consideration is unconditional, but compliance with the standard is left to the auditor's judgment. So let me guide you through this. First, the phrase unconditional requirement is your golden trigger. Whenever you see it, you should immediately think, no exceptions, no excuses, no documentation outs. If you skip it, your audit cannot be said to follow GAS. Now, when I look at option A, it says the auditor must comply in order for the engagement to be in accordance with GAS. This matches exactly what we just said. Unconditional equals must. So option A is correct. Then I read option B. This one says only if the client is new. Exam tip here: anytime an answer limits GAS to special circumstances, like first-time clients, that is a red flag. GAS applies universally, not selectively, so you can confidently eliminate this. Next, option C says the auditor should comply or else must document why not. This is where the examiners love to trap you. That language belongs to presumptively mandatory requirements. The word should plus document departure is the classic exam signal of presumptively mandatory, not unconditional. So if you see that combo, you know it is the wrong answer in this context. Now option D tries to soften the rule. It says consideration is unconditional, but compliance is up to judgment.
On exam day, whenever you see an answer that leaves compliance to judgment, your alarm bell should go off. That is not unconditional at all.
This one is out. So after breaking each down, the correct choice is A. Now, let me pause and give you some practical exam strategies for this type of question. First tip, when you see the phrase unconditional requirement, lock on to the word must. That is the key. If you see answers using should or judgment or document departure, cross them out immediately. Second tip, remember the exam loves contrast. They will mix unconditional with presumptively mandatory to test if you know the difference. So train your eyes. Must is unconditional. Should with documentation is presumptively mandatory. Third tip, ignore distractions like only for first-time audits or only in special cases. Standards apply across the board. If an answer limits gas to one situation, it is almost always wrong. Fourth tip, think of unconditional requirements as zero-flex standards, like wearing a seatbelt in a car. You cannot say, well, today I considered it, but decided not to. The rule does not bend. Fifth tip, on multiple choice exams, the most precise and absolute language is usually the correct choice here. If you see an answer that sounds soft, like generally expected or left to judgment, those are exam traps. So, the takeaway is simple. In the world of gas, unconditional requirements mean no exceptions. If you want to say you followed gas, you must comply. The exam tests this by mixing in should language from presumptively mandatory requirements. Spot the difference, and you get easy points. Which of the following is correct regarding a covered member of an audit engagement? 1. If the dependent child of a covered member owns $300 worth of stock in an audit client, the covered member would still be independent if the dependent child were under age 5. 2. If the spouse of a covered member owns an immaterial indirect financial interest in the audit client, the covered member would still be independent. A. 1 only. B. 2 only. C. Both 1 and 2. D. Neither 1 nor 2. Okay, so now let's go statement by statement and squeeze all the juice out of this. Statement 1. We've got a dependent child owning $300 worth of stock in the client. My first instinct as a human is to laugh and say, how could a toddler's piggy bank stock wipe out an entire CPA firm's independence? But the rule under the AICPA is crystal clear. Any direct financial interest in the audit client by a covered member or their immediate family impairs independence. An immediate family means spouse and dependent children. No exceptions for age, no exceptions for dollar amount. So, if a dependent child owns even $1 of stock directly in the client, independence is gone. That $300 holding is more than enough to blow it up. And the detail about the child being under 5, that's a red herring the examiners throw in to see if you'll fall for it. Age doesn't matter. Independence doesn't magically reappear when the kid is too young to spell audit. Verdict, statement I is false. Statement 2. Now let's move to the spouse. The spouse owns an indirect financial interest in the audit client. What does that mean? It means they're not holding the client's stock directly, but instead they own something like a mutual fund that happens to invest in the client. Here, materiality does matter. If the spouse's indirect interest is immaterial, independence is not impaired. The logic is, if your spouse's 401k mutual fund owns a sliver of Apple stock, you're not suddenly barred from auditing Apple. As long as it's tiny and indirect, you're okay. So statement 2 lines up perfectly with the rules. It's true. Putting it together. Now, when I compare both statements, only the second one survives. The first one dies because direct interests are absolute independence killers, regardless of age or amount. The second one works because indirect, immaterial interests don't impair independence. So the correct answer is B, 2 only. Here's how I always frame it for myself. Direct equals dead. Any direct ownership of a client's stock, whether by you, your spouse, or your dependent child, destroys independence. Doesn't matter if it's one share worth the price of a sandwich. Indirect equals it depends.
Indirect ownership, like through a mutual fund, depends on whether it's material or not. So, if you see a toddler with stock, independence is dead. If you see a spouse with a tiny piece of a mutual fund, independence depends, and if it's immaterial, you're fine. And the punchline memory hook? Picture this: a baby chewing on a stock certificate and an auditor crying into their work papers. That's direct. Independence gone. Then picture a spouse scrolling through their 401k saying, "Oh, look, I have 0.0002% of Walmart." That's indirect, and that one doesn't kill independence. Final answer, said with confidence, B. 2 only.
Okay, now let's unpack this. According to generally accepted auditing standards, which of the following must be expressed in a standard auditor's report? The auditor's conclusion that consistent accounting principles were applied from period to period, the auditor's opinion that the financial statement disclosures and footnotes are sufficient and appropriate in the circumstances. Choice A says 1 only, choice B says 2 only, choice C says both 1 and 2, choice D says neither 1 nor 2. Okay, now let's unpack this. Starting with number 1. Does the standard report include the auditor saying, in plain words, yes, accounting principles were consistently applied? The answer is no. That used to be a separate consistency paragraph many years ago, but under current JAS, consistency is only mentioned when there's a lack of it. In other words, if the principles weren't applied consistently, then I, as the auditor, would bring it up. But if everything is consistent, I don't make a separate conclusion about it in every standard report. So number 1 does not have to be express. Now number 2, does the auditor's report state an opinion on whether the disclosures and footnotes are sufficient and appropriate? Again, the answer is no. The report gives an opinion on whether the financial statements as a whole present fairly in all material respects, in accordance with the framework. That overall opinion includes the disclosures, but I don't separately say, I think the footnotes are sufficient and appropriate. That's baked into my overall opinion, not a separate expression. So when I look at both statements, neither of them is something I must explicitly express in a standard auditor's report. That leads me to choice D, neither 1 nor 2. And here's the memory hook. Picture me writing the audit report like a polite restaurant review. I don't write, the waiter consistently wore the same tie every day. That's like consistency. I only mention it if it changes. And I don't say, the salt and pepper shakers were specifically sufficient. That's like disclosures. It's already wrapped into the full dining experience review. I just give one clean opinion overall. Final answer? D. Neither 1 nor 2. All right, let's really dig into this one. I'll read the question first, then expand the explanation with the latest standards, side notes, and exam tips. Here's the question. Whenever an independent expert is brought in to examine financial statements with hopes of adding credibility, that engagement and reporting process is known as an audit, an attestation, choice A says 1 only, choice B says 2 only, choice C says both 1 and 2, choice D says neither 1 nor 2. Okay, here's how I'd break it down. First, number 1, an audit. Under the latest generally accepted auditing standards, GAS, an audit is defined as an examination of historical financial statements by an independent auditor, resulting in an opinion on whether the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework, like GAAP or IFRS. The key words here are historical financial statements and opinion. The purpose is credibility. So yes, when I, as a CPA, do an audit, I'm adding credibility to the client's financials. So number 1 is correct. Now number 2, an attestation. Here I have to pull in the AICPA's attestation standards, known as SSAEs, Statements on Standards for Attestation Engagements. An attestation engagement is when I, as the CPA, report on subject matter or an assertion that another party is responsible for. It's broader than an audit. Examples include reviews, agreed-upon procedures, and examinations. And here's the important part. Audits fall under the umbrella of attestation engagements. That means every audit is an attestation, but not every attestation is an audit. For instance, if I just review the financials and issue limited assurance, that's an attestation, but it's not an audit. So when you ask, what do we call it when an independent expert examines financial statements to add credibility, I can truthfully say it's an audit, and I can truthfully say it's an attestation.
That's why both 1 and 2 are correct. Now, let me tack on a couple of exam tips. 1, the exam loves this umbrella logic. Think of attestation as the big category, with audit, review, and agreed-upon procedures all tucked underneath. If you see a question like this where both the broad category and the specific type are listed, the answer is almost always both. 2, don't confuse attestation with assurance. Assurance engagements are even broader. They include things like CPA consulting services or compilations, which technically are assurance but not attestation. So the hierarchy goes assurance, biggest, then attestation, middle, then audit, a type of attestation. If you keep that pyramid in your head, you'll nail these questions. And here's the punchline to remember it. I like to say, all pizza is food, but not all food is pizza. All audits are attestations, but not all attestations are audits. If you're hungry, that's a 2-for-1 memory hook. Final answer, choice C, both 1 and 2.